Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So let's look at another currency pair. This is the dollar-yen. Of course, if we were to do our little triangle here, we would say that the dollar-yen, we've got the dollar on one side over here on the left, and then we have the yen on the right-hand side. So if we thought that the yen was going to become worth more relative to the dollar, so if we thought the dollar was going to weaken, then we would anticipate that this currency, that it would tip that seesaw, sloping down and to the right, which means that the trend would be down and to the right, which is in fact where our longer-term trend is. It's more or less biased to the downside here. Now, there's all kinds of funny things going on here with the dollar-yen. If you are, if you spend a lot of time in the stock market, you may not know this. But I think most Forex traders are aware that the dollar-yen has a really interesting correlation with stocks in general because it's impacted by a lot of the same things. So traders who are concerned about risk in the market, if they start to develop a lot greater risk appetite, then oftentimes they'll actually short the yen, which will actually drive this pair to the upside. And which would be the same direction that stocks would go, because stocks are a higher risk investment, and so if trader risk appetite is growing, then they'll buy stocks as well. By the same token, traders who are concerned about risk may actually buy the yen, so they'll cover some of those short yen positions, and it will drive the dollar-yen to the downside. So this is a really, which would be the same direction that stocks will go. And in fact, right now, we're in an interesting situation on the dollar-yen. So I'm just drawing a line to meet the lowest low, or the lowest most recent low on the dollar-yen. You'll notice it lines up pretty well with the, we're kind of cutting through a couple of shadows here that occurred in November of last year, but it lines up pretty well with the real bodies that we saw, the real trading range on right there at the very end of November of last year, and we're getting pretty close to support this double bottom that occurred there in December and in January. So I'm going to zoom in again. So traders are looking at this. Forex traders are looking at this, and they're thinking, okay, well, let's say that we have an opportunity to the upside. You know, we have a channel in place that's actually quite wide, and here to the upside, we probably have some, fairly significant level of resistance at about 94.50. So traders looking at this, they're thinking, well, I have 600, 650 pips to the upside if the market were to go all the way up. So let's say that stocks started to look a lot better. I mean, we've been on a little bit of a bull run, and we've run into a little bit of resistance today, but we've been on a bit of a bull run. Earnings are looking pretty good. There's a trickle of bad news, but nothing that looks too alarming right now. What if what if the market does start to rally and we start heading back up to April highs in the stock market? We would expect the dollar-yen to kind of follow that. Now, the dollar-yen is also going to be impacted by just the relative strength of the dollar, too. So if U.S. equities started to rally a bit, and if Europe continued to languish a bit, which wouldn't be a big surprise, some of the austerity measures that they're putting into place are probably going to constrain growth. So traders may start to price that further into the European markets, and that may actually help strengthen the dollar a bit. So we could have a number of factors at play that drive the dollar-yen right up to the upside. A little bit of strengthening in the dollar, a little bit of strengthening in equities, a little bit of a growing risk appetite out there in the markets. We'd see traders coming in to short the yen. All of this may combine to create this opportunity, and a lot of Forex traders are looking at it right now. In fact, we had a really big day in the market to the upside just today on the dollar-yen. So, so this gets us back to the same question. we could go long the dollar yen. And to try to control market risk, most traders would say, well, okay, if I'm targeting 600 pips to the upside over the next several weeks, then maybe I'm placing a 150 pip stop, a 100 pip stop, a 200 pip stop. I don't know. It's got to be big enough that the market, as it moves up and down, I don't get stopped out and whipped out of my position a number of times, because wouldn't that be frustrating? It's the same situation here back in May. What if we'd been targeting the 600 pips to the downside and then had been stopped out over and over again every time the market retraced? So that can be very frustrating for traders. So we want to leave that nice and wide. Or alternatively, we're in a situation where we could construct a very straightforward trade using FX options. Maybe we would buy a call. Or alternatively, the reason why I brought this trade up is that there is a lot of debate right now. What's going on with the dollar yen? I mentioned that it has this really interesting correlation with equities, and yet, so I'm going to show you another chart here just to make a point. The green line is the S&P 500. The candlestick chart is the dollar yen. So you can see, it does have a very strong correlation, but over time, that's actually been weakening quite a bit, and it's beginning to diverge a lot. So as equities have been performing since early 2009, the yen just has not been following. So it is losing a bit of that normal correlation that we look for, and that puts us in an interesting situation where the debate now becomes, that you're seeing amongst traders who are getting ready for a fairly significant position, is I would say, I've just been talking to a lot of traders on the institutional side as well as the retail side. I'm seeing a really even split between traders who are expecting a bounce, 600 pips potential to the upside, up to the upper level of resistance, to those who are expecting that the Bank of Japan may not be able to intervene effectively, and that the yen may actually start to strengthen quite a bit, especially if all of a sudden one of these lurking unknowns that we don't like to think about very much, but let's say another Asian financial crisis. We know there's little things bubbling over there that could spring out of nowhere on us, or the European credit crisis, et cetera. So there's some of these unknowns that are still kind of lurking, and that may explain some of the reason why this normal correlation that we see that's real strong between equities and the dollar yen has been getting a little bit weaker. So traders are looking at this and they're saying, well, we're nearly evenly split. Well, there are ways to take advantage of this. So a lot of retail Forex traders will construct this as kind of a hedged trade or a hedged position. So they'll enter both a long and short position at the same time, and then they'll lift the loser once the market actually starts to break out. There's a lot of very mixed opinions on how advisable that kind of a trade is. Or alternatively, they'll set entry orders up above and maybe below the market, like this. So they'll have a limit order to go long if the yen actually breaks out to the upside, and they'll have a limit order to go short if it breaks down below support, and then they'll kind of live with the trade that they're in. But so Forex traders, they look at this and they think, well, maybe I should have both a long and a short position, which is oftentimes called a hedge, which is a little bit different than the way option traders might think about and use the term hedging. So you can actually construct a trade with Forex options that use the benefits, that take advantage of the benefits that I mentioned when we were looking at the euro dollar, that is fairly neutral while still being limited risk.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.